Every personal finance personality on the internet has a strong opinion about this. Dave Ramsey says 15-year mortgage, always non-negotiable. The FIRE community says 30-year mortgage and invest the difference. Your parents probably say pay it off as fast as you can. Your lender will show you whatever makes you most comfortable signing. Here is the problem with all of those takes. None of them know your specific income, your job stability, your other financial goals, or your risk tolerance. They are giving you a universal answer to a deeply personal question. In this video, I'm going to show you the actual math on both options, no agenda, no affiliation, and give you the framework to figure out which one is right for your specific situation. Because the correct answer genuinely depends on who you are and where you are in your financial life. Let us start with the math on a $300,000 mortgage, so we have a concrete comparison to work with. On a 30-year fixed mortgage at 6.8%, your monthly principal and interest payment is $1,961. Over 30 years, you will pay a total of $705,960. That means you pay $405,960 in interest on a $300,000 loan. More than the loan itself, on a 15-year fixed mortgage at 6.2%. 15-year rates are typically half a point to 3/4 of a point lower than 30-year rates. Your monthly payment is $2,578. Over 15 years, you will pay a total of $464,000. Total interest paid is $164,000. The difference in total interest paid is $241,960. You saved nearly $250,000 by choosing the 15-year. But your monthly payment is $617 higher every single month for 15 years. That is the trade-off, and it is a real one. The 15-year is not universally better just because the total interest number is lower. The question is what that extra $617 per month costs you in terms of financial flexibility, and what it would be worth if you deployed it differently. The 30-year mortgage gets dismissed by the pay-it-off crowd as financially irresponsible. The math does not support that framing. The first argument for the 30-year is flexibility. Your minimum required payment is lower. In a month where your income drops, job change, medical expense, market downturn, you are not locked into a higher obligation. You can always pay more than the minimum on a 30-year mortgage and replicate the 15-year payoff schedule voluntarily. You cannot pay less than the minimum on a 15-year without defaulting. The second argument is opportunity cost. The $617 a month you save with the lower 30-year payment can be invested. If you invest that $617 a month in a diversified index fund, earning a historical average of 7% annually over 15 years, you end up with approximately $200,000. You have not paid off the loan faster, but you have built a parallel asset that has its own value and liquidity. The third argument matters specifically for first-time buyers. In the early years of home ownership, unexpected costs are highest. New appliances, deferred maintenance, the inspection missed, repairs you did not budget for. The lower payment of a 30-year mortgage gives you a financial buffer during the period when you need it most. The fourth argument is inflation. A fixed mortgage payment becomes cheaper in real terms every year. As inflation rises, the $1,961 payment you commit to today will feel meaningfully smaller in 15 years when salaries and prices have risen around it. The purchasing power of your fixed payment erodes in your favor over time. The 15-year mortgage is not the right choice for everyone, but for specific types of buyers, it is genuinely the superior financial decision. The most compelling case is the rate difference. 15-year mortgages typically carry rates half a point to 3/4 of a point lower than 30-year mortgages. That rate advantage compounds significantly over time and means you are building equity faster from the very first payment. The second case is discipline. For buyers who are honest with themselves about the fact that they will not invest the difference, that the extra $600 a month will get absorbed into lifestyle spending rather than a brokerage account. The forced savings of the 15-year is a better outcome than the theoretical investing upside of the 30-year that never actually happens. The third case is the buyer in their 40s or 50s who is purchasing their first home later than average. A 30-year mortgage taken at 45 means a payment obligation until age 75. A 15-year means the home is paid off at 60 before retirement. That timeline alignment has real value beyond pure interest math. The fourth case is the buyer with exceptional job stability and no other high-interest debt. If your income is predictable, your emergency fund is solid, you have no credit card debt, and your retirement contributions are already maximized, the 15-year is simply a disciplined acceleration of wealth building that the math supports. Here is the option that the 30 versus 15 debate almost always leaves out, and it is the one that works best for a large portion of first-time buyers. Take the 30-year mortgage. Make 15-year payments voluntarily when you can. Stop when you can't. Most conventional mortgages have no prepayment penalty. Every dollar above your minimum payment goes directly toward principal. If you consistently pay the 15-year equivalent amount on a 30-year mortgage, you will pay off the loan in approximately 15 years and save nearly the same amount in interest. But in any month where life happens, job loss, medical bill, family emergency, you can drop back to the minimum payment without defaulting. This is the flexibility of the 30-year with the payoff timeline of the 15-year, available to any buyer who has the discipline to execute it. The way to implement this practically is to set up your mortgage autopay at the 30-year minimum and create a separate automatic transfer to a dedicated account on the same date. When you are financially comfortable, you make an additional principal payment from that account. When you are not, you leave it as a buffer. You never miss a payment and you never pay more than you can afford. This is not a trick. It is just using the structure of a 30-year mortgage the way it was designed to be used, as a minimum obligation, not a maximum commitment. The 30-year versus 15-year debate is not a debate about which product is better. It is a question about who you are financially. If your income is variable, your career is early, your emergency fund is still being built, or you have other financial goals competing for the same dollars, the 30-year gives you room to breathe while still building equity. Make extra payments when you can. If your income is stable and predictable, your other financial obligations are under control, and you are starting this purchase later in life with retirement on a specific timeline, the 15-year is the more aggressive path to an asset you own outright, and the math supports it clearly. The worst decision is picking one based on someone else's philosophy without running your own numbers first. The second worst decision is assuming the monthly payment is the only number that matters. Total interest paid, rate differential, investment opportunity cost, and your personal financial reality are all part of this calculation. Now you have all of them.